Here's the closing bell for today, Tuesday, April 19th.
And that was the closing bell on Wall Street. Let's check on the three majors now before we get to our panel. A lot of green on the board. We stayed high. The Dow leading the way, up 1.5%. The S&P 500 up 70-point gain. And the NASDAQ, a big day. The big leading all the gains there, up now to 13,619. Those are how your three indices close on the day. And with that, a brand new hour of Yahoo Finance Live. Welcome back in. I'm Dave Briggs alongside Brad Smith, Michelle Akufo. Let's bring in our panel for you. Jacqueline Remmen, Morgan Stanley Private Wealth Management, Private Wealth Advisor, and Senior Vice President, also Cameron Dawson, Fieldpoint Private Chief Market Strategist. Cameron, we'll start with you and your takeaway from these optimistic green numbers on the board.
So today was really interesting because we saw the tech sector rally the most, even though yields were moving higher. And even though we've seen these big rallies in some of the tech names, they're still trading below their downward sloping averages. Maybe it's a 50-day moving average that for the overall NASDAQ. So we really haven't seen this be a big trend change in a day. So we wouldn't call the all clear sign because yields still are moving higher. And we know that those higher yields, mostly real yields, should put downward pressure on tech names, on growth names. So we don't think that we're out of the woods yet. We wouldn't call the all clear on this and see it more as just a bounce off of oversold after really weak trading days over the last week.
And Jacqueline, as you see there, we're sort of just in the upswing now of the Q1 earnings season. What are your expectations based on what we're seeing in some of perhaps the bellwethers, things like financials that we've seen already come out with earnings so far?
Yeah, thanks so much. It's great to be here. Thanks for having me. Yeah, we've seen, earnings look pretty good, and we know that obviously we're seeing that today with the trading activity that took place across the board. We think that earnings positivity is going to be led by the sectors that are the least interest rate sensitive, like energy, healthcare, real estate, and we're really focused on that. As we know, 15% of companies are reporting earnings this week across the S&P 500. And what we're telling clients is to put that in the broader perspective of their portfolio and shift for what we see right now, which is higher interest rates and inflation as a part of their broader portfolio, and what that means being investing in quality and defensive.
Cameron, we also saw oil prices retract a little bit today. What does that tell you about how these markets are still paying close attention to energy prices right now and factoring that into the equity markets as well, especially considering some of the supply chain implications and even all the way through some of the energy prices that consumers are paying too?
Yes, there certainly was a narrative that emerged today when you had lower oil prices combined with higher stocks, that lower oil prices are good for consumers, and that's why we're seeing things like consumer discretionary rally. But would make the point that it's not just about oil prices for the consumer. And when we're thinking about how inflation could impact demand, oil is in energy overall is only about 6% of the consumer spending. But when you add other things like food and housing, that jumps to 47% of consumer spending. And so we're seeing all of these prices rise. So we're really on the lookout for signs of demand destruction within the consumer. And we're already starting to see in this earnings season some companies calling out some fraying in that lower income consumer. JP Morgan talked about inflation being a risk and having to make more credit charge-offs or reserve for more credit. We've heard from places like Bed Bath & Beyond or Tempur Sealy that consumers really are tightening their belts. And even there was a report out in the UK about how consumers were starting to cancel video subscriptions because of inflation. And so we're starting to see early signs that there is some demand destruction for consumers because of higher prices.
And part of that, Jacqueline, is the question of has inflation yet peaked, given that 8.5 number we saw a week ago? Do you think it is down from here?
Yeah, Morgan Stanley is expecting year-end inflation to end around about 6.8%. So definitely a little bit lower from here over the course of the year. But we're structuring client portfolios to be set for inflation, favoring the sectors that benefit most from inflation and being able to adjust prices. Real estate, for example, being able to re-rate across rent, in financials, in healthcare, and also in utilities, and structuring that across our client broader portfolios too, for clients who maybe are holding a lot of cash, knowing that, the best way to earn their way out of inflation is by owning assets that are appreciating in value. So incorporating that into a broader financial plan for our clients.